All right, picture this. You're, checking your investments and you see a stock in your portfolio has made a pretty nice jump. Feeling good, right?
Definitely.
But then you look at your passive fund that tracks that same stock,
Yeah.
and the gain isn't quite what you'd hoped.
Yeah, I've been there.
It's like finding out your, favorite band's concert is sold out,
Oh, no.
but only in the, nosebleed section.
Yeah.
That feeling, it's the sting of tracking error.
Right.
And it's the big reason why India's market watchdog, SEBI, is about to make some pretty big changes.
You're absolutely right. And that frustration you're describing, it's getting more and more common,
Yeah.
especially with, well, how popular passive funds have become in India.
Yeah.
These funds, the ones that are supposed to, mirror how certain indices are performing, well, they're now managing something like 11 lakh crores. Yeah, that's 6 times what they were managing just back in 2020. Think about it. Every little bit of tracking error, every tiny discrepancy, it gets multiplied across these massive, massive funds.
Right.
And that means a lot of potential gains just left on the table for investors.
So before we dive into what SEBI's got planned, maybe we should break down exactly what the problem is. Right now, India uses, it's called the volume-weighted average price, or VWAP, to figure out a stock's closing price.
Okay.
It's basically taking an average of the prices over the last half hour of trading. But here's the thing. The trades with larger volumes, they actually carry more weight in that calculation. Sensible enough, right? But
Yeah,
sometimes, not always. Things can get a little
wonky.
wonky is a good word for it.
It really is. Think of it like this. Say there's a company, let's call it, I don't know, Hello Ltd. For the day. And most of the day, this company is trading, around 130 euro on or a one. Pretty stable. Then, right before closing time, some big investor comes along, decides to dump a ton of shares. And they do it at, let's say, 110. Suddenly, that one big trade, it drags the whole closing price down.
Even though most of the day it was at a higher price.
Exactly. That's the problem.
So even if everyone was, buying Hello Ltd. At 101 all day,
Right.
One last-minute fire sale makes it look like the stock tanked.
Rough way to end the day. That's exactly what SEBI is trying to fix.
So what are they thinking?
They're proposing we move to what's called a closing auction session. We can call it CAS. It's something that's actually already used in a lot of big markets, the U.S., the UK.
Yeah.
Even Hong Kong and South Korea do it this way.
Okay, so how does CAS work?
So right after the regular market closes, they have a little auction. Buyers, sellers, they submit their bids. And the price with the most matching trades, that becomes the official closing price.
So back to our Hello Ltd. Example.
Yeah.
If most of the trading was happening around, 101,
Right.
CAS would probably put the closing price right there.
It should.
More reflective of what really happened.
Exactly.
Yeah.
Much fair, don't you think?
Sounds like it.
Yeah.
Anything else the CAS is supposed to do?
Well, it's more than just fairness. It should make things more transparent, too. You see, all the bids, all the offers, they're all out in the open during this auction.
Okay.
And this is really important for those passive funds we were talking about. This system, it could really cut down on those tracking errors.
Oh, I
Closing price is more accurate. Those passive funds can do a much better job of mirroring those target indices.
It's like getting rid of that old blurry TV.
Oh, yeah.
And finally having a nice sharp HD picture.
Yeah, exactly. You get a much clearer, more accurate view of what's really going on.
And it's not just about clarity.
Yeah.
By, minimizing the impact of those last-minute trades, CAS could make it a lot harder for a few big players to manipulate the closing price, just to benefit themselves. So CAS could be kind of like a market referee, making sure everyone plays fair.
I like that analogy.
But wait a minute, haven't we heard some things about Hong Kong's experience with CAS? I thought they had some kind of, mishap back in 2008.
Yes, you're thinking of the HSBC incident?
Mm-hmm.
It's definitely a reminder that even when you've got safeguards in place, things can still go wrong, things you don't anticipate.
Tell me about it. One trader, just one, managed to exploit a loophole in the system.
Oh, wow.
And they sent HSBC's price plummeting, like 10%,
Right.
just before closing.
Wow, that's rough.
Luckily, it was temporary. The price bounced back the next day, but it definitely showed that CAS, well, it's not a foolproof solution.
Right. And that's why SEBI is, well, they're trying to be cautious here. They're learning from what happened in Hong Kong. So they're planning on rolling this out in phases.
Yeah.
Starting with the most liquid stocks, the ones linked to derivatives,
Hmm.
minimize those risks. They're also adding some extra safeguards.